Hi, I'm Puneet Singh from Nanak Accountants, a registered tax agent here in Australia, and today I want to walk you through one of the most powerful but misunderstood tax strategies that is called the 6-year capital gain tax rule. If you ever moved out of your home, which we call PPOR, and rented it out, and now you're thinking to sell that house, this one rule could be the difference between paying 80,000 plus in taxes or paying nothing to Australian Taxation Office. Let's start with how it works in a simple language, real numbers, and smart tips. When you sell a property in Australia and make a profit, that profit is generally subject to capital gain tax in Australia. And now, if it is your main residence, the home you lived in, which we called PPOR, that sale is exempt from capital gain tax. That's pretty easy, simple. But what happens when you moved out and put that property on rent? That's where this 6-year rule comes in. The ATO allows you to keep calling that property as your main residence for tax purposes for up to 6 years absent rule after you moved out, even if it is rented. But keep in mind that you can only treat one property as your main residence as a PPR, and you did not move into any other property or home you owned as a PPR. This is very important. Let's say you bought a house in 2010 for $300,000, lived it in for 7 years, and then rented it out from 2017 to 2022, and you sold it in 2022 for $1 million. Now the gain is $700,000. But because you lived it in first and then rented it out under 6-year absent rule, the entire gain is tax-free. No tax, no reporting of capital gain tax, but you must meet a few conditions. You did not move into any other home, you called it as a PPOR. You had a valuation done before you moved out. You sold within 6-year rule limit. And now people are going to question me, what if you rent that property for more than 6 years before you sell it out? Now, it's get a little more complex, but still manageable. You will have to pay capital gain tax on the part of the gain after that 6-year window ends. And there are two methods to calculate this. One is market value method, where we get a property valuation done on the day you moved out. And there is another one called Parata Method. We calculate tax based on how long you lived versus rented. Whichever gives you the best and the lower tax rate, we use that particular method. Here is a trick many don't realize. If you move back into that property even just for a short period, the 6-year clock resets again. You get a fresh 6 years to rent it out again. Just update your driver license, put utilities bill in your name, get email sent there, show ATO that you genuinely moved in back, even for just 2 weeks, 3 weeks, or a month. You don't need to stay long, just enough to prove that you re-establish residency. There are a few things to note as well. Couples count as one tax unit, not two. You need to choose one property together. Foreign resident don't get this exemption, unfortunately. You must be an Australian tax resident at the time of sale. And remember, you can choose which property you can claim the exemption on, but only if you lived in both. So if you lived in one particular home, moved out, rented, sold it within 6 years, you may not have to pay capital gain tax at all. It's tax free. But if you rented it out longer or own any other property as a PPR, that is where we get into calculations, valuations, and strategy. So the takeaway, don't sell without any advice. One mistake can cost tens of thousands in unnecessary tax. If you need any guidance on capital gain tax, you can contact our friendly team. We can be contacted at 1300 You can read our blogs on our website www.nanakaccountants.com.au. Thank you. Sat Sri Akal.